You know, we've all seen the Hollywood version of being rich, right? It's all super yachts and champagne parties. But what if I told you that for the really wealthy, money isn't just for spending? It's a tool. It's a key piece in a very complex game of growth and preservation. So, let's break down the real playbook.
So what do they really do with all that cash? It's not just about buying more stuff. It's about putting that money to work in some very specific and, honestly, very powerful ways.
This slide just nails the difference between what we think we know and what's actually happening. While we see the yachts and parties in the headlines, the real action is happening behind the scenes. It's way less about random luxury shopping and way more about sophisticated strategies like tax loss harvesting, super plan philanthropy, and even entire companies called family offices that are built just to manage one family's fortune.
Okay, to really wrap our heads around this, we first have to get one thing straight. Wealth isn't just one big bucket. It's a ladder. And trust me, how you use your money changes a lot as you climb it. So here's how the financial world actually breaks it down. When they say investable assets, they mean things like stocks and bonds, not the value of the house you live in. It kicks off with the mass affluent, who are often focused on things like retirement, and it goes all the way up to the ultra-high net worth individuals, or UHNWIs. These are the folks with over $30 million ready to be put to work, and that's the group we're really going to focus on today. So why do we care so much about this group? Well, get this. High net worth and ultra-high net worth individuals together control a staggering 45% of the total market value. They're not just playing in the global economy. They're the ones providing the cash that makes it run. Their decisions literally start market trends.
All right, so now that we know who we're talking about, let's peek inside their portfolios. Let's see where they're actually putting their capital, because it's all part of a very careful strategy designed for both growth and protection.
This donut chart tells such a fascinating story. You see that big 42% slice? A typical portfolio is dominated by what they call alternative investments. So what are those? These are assets you can't just buy on an app on your phone. We're talking about private equity, owning a piece of a company before it goes public, or venture capital that funds the next big startup. It's all about finding growth that isn't tied to the crazy up and down swings of the stock market. And this strategy is always in motion. It's constantly shifting. As we look towards 2025, you can see a really clear move towards public stocks, especially in AI and tech, and also into real estate to protect against inflation. At the same time, they're pulling money out of fixed income and cash. Why? Because with interest rates expected to fall, just letting that money sit there is a huge missed opportunity. It has to be put to work.
Now, underneath all of these trends is one of the biggest economic shifts in history. It's called the Great Wealth Transfer. We're talking about an estimated $84 trillion moving from the baby boomer generation down to their kids and grandkids. This is changing absolutely everything.
And you know, this isn't just a transfer of money, it's a transfer of philosophy. The older generation, they were largely focused on just preserving that wealth. But the next generation, they're far more willing to take risks. They have a huge appetite for things like digital assets and crypto. And they're also driving a whole new kind of investing, value-based investing, where they demand that their money aligns with ESG criteria, which stands for environmental, social, and governance factors.
But aggressive growth, that's only half the battle. To build a true legacy, you also have to build a fortress around your wealth. It's not just about making money, it's about protecting it so it lasts for generations.
And here's something that might surprise you. For the ultra-wealthy, we're talking people with over $25 million, their spending actually flatlines. It hits a plateau. I mean, there's a point where you can only buy so much stuff. After that, any extra income isn't spent, it's repurposed.
This chart just visualizes that difference so dramatically. Look on the left. An average household might save or invest a small slice of their income. But on the right, for an ultra-high net worth individual, up to 80% of their income just becomes free cash flow. And that cash is not sitting around. It's immediately put right back to work to generate even more passive income.
So how do they protect all this growing capital? Well, one of the most common tools in the playbook is something called tax loss harvesting. To put it simply, it's about using your losses to your advantage. You strategically sell an asset that's not doing so well to cancel out the taxes you'd owe on your big winners.
Let's make that real for a second. Let's say you made a $50,000 profit on one stock. Nice! But to cut down the tax bill, you could sell another investment that happens to have a $30,000 loss. And just like that, poof, your taxable gain drops all the way down to just $20,000.
It's a standard play for maximizing what you actually get to keep. Of course, it's not the Wild West. You can't just game the system. There are some really important guardrails, like the wash sale rule. That rule stops you from selling a stock for a tax loss and then immediately buying it right back within 30 days. It makes sure that you're actually taking a real loss, not just creating a fake one on paper for tax purposes. Sooner or later, this long-term thinking goes beyond just personal wealth and starts to focus on legacy. And one of the most powerful ways to do that is through strategic philanthropy. Let's look at a really interesting example. In Turkey, it's a centuries-old practice for wealthy families to create foundations, building a formal structure to aim their capital at a specific social cause.
And this is a serious commitment. In 2025, just to start a new foundation in Turkey, a family has to put up a minimum of 2 million Turkish lira. This really formalizes the whole process of turning private wealth into a public good. This example from Turkey really points to a much bigger global trend, the professionalization of wealth. We are seeing a huge shift towards more structured, more institutional ways of managing and preserving family fortunes for many, many generations to come.
So to pull all of this together, we can think of money, for the wealthy, as having 4 distinct jobs to do. This framework really helps synthesize everything we've been talking about.
First, it's a growth engine, used to multiply itself through investments. Second, it's a protective shield, using all those tax strategies and legal structures to keep it from eroding. Third, it acts as an access key, unlocking elite networks and social capital. And finally, number 4, it's a legacy bridge, transferring not just wealth, but also values to the next generation through things like foundations.
And that, right there, is the fundamental takeaway. For the ultra-wealthy, money isn't the finish line. It's a dynamic, powerful tool that's used to actively shape the future. Which really just leaves us with one final thought to chew on. If you thought of your own money, not just as something to be spent, but as a tool that has a job to do, what job would you give it?